Hello, I'm Ross Youngman from Ausbil Investment Management, and I'm pleased to be here in the offices of MacKay Shields in New York City. We've got the beautiful park behind us here, and I'm very pleased to be with Cohen, Senior Managing Director and one of the 4 senior portfolio managers here. Lou and I last caught up in Sydney in April, so it's nice to be here in New York this time around. Getting down to business, the purpose of our interview today is to really introduce the Ausbil investment community to the new unconstrained bond fund that we're launching in conjunction with MacKay Shields. Lou, tell me a little bit about unconstrained bond funds and where they fit in a portfolio for investors.
Sure, Ross. First of all, welcome to New York. Nice to see you here, certainly. Unconstrained, really conceptually, the key is that you can detach yourself from a traditional bond benchmark, be more flexible, certainly be subject to guideline constraints, but formed however it's appropriate away from a typical benchmark. Gives you the flexibility to invest more efficiently, we believe, as well as to avoid some of the problems that typically occur within a traditional benchmark at different points in the cycle.
And tell me a little bit about how long MacKay Shields has been running Unconstrained Bond and a little bit about the team.
Sure, we began with our first unconstrained portfolio almost 6 years ago, I believe. The team has been together running fixed income, many of us, for over 20 years now. So it's a long life team. It's very much a team framework. So I'd have to be sitting here with you today, but any of my colleagues could do the same. But we are significant advocates of the unconstrained framework. I think we're now managing around $5 billion US in the strategy.
And in terms of unconstrained bond, it means different things to different people. So what's the MacKay Shields' particular take on unconstrained bond?
Sure. I mean, we try to set up our unconstrained approach to play to our strengths, which we believe really are most significantly twofold. One of which is credit selection, which is particularly important in the bond market, and the other is asset allocation. And asset allocation is critical, of course, in an unconstrained framework because you're operating without the severe constraints you usually are. So over a full market cycle, we believe we can add value by operating in that unconstrained framework using our asset allocation skills.
Lou, interest rates are at record lows. How can the MacKay Shields Unconstrained Bond Fund help investors achieve their investment goals?
Considering our outlook for the economy, both globally and certainly here in the States, we believe the opportunity continues to earn additional return within the corporate sector, including higher yielding securities. If one thinks about moderate growth and the yield spreads that these securities are offering, we think it continues to be an attractive combination, particularly against a backdrop of low default rates, most importantly, away from the commodity sensitive sectors. So decent economic growth, low defaults, attractive spreads, those are a good combination. In addition to that, the fund takes advantage of keeping in the present cycle, of keeping its interest rate sensitivity, its bond duration, to a particularly low level. So the duration of the portfolio today is approximately 1 year. It will keep, again, the sensitivity to an increase in interest rates to a minimum. And in our view, and now increasingly in the market's view, with the Federal Reserve in the process of beginning again to hike short-term interest rates, the combination of the additional yield in the corporate securities and the desensitivity or the desensitizing of the portfolio to the backup in interest rates, we think that combination best suits the fund for an optimal rate of return at this point.
And the Australian Unconstrained Bond that's been launched, what's the frequency of distributions in that fund?
It's quarterly.
Okay. Now, Lou, spreads widened earlier in the year, and there was a fear that risk was back on and that there was going to be problems going forward. How did you manage the Unconstrained Bond Fund during this period, and what changes did you make?
One of the things that may not be obvious to everyone, but certainly is part of our daily life, is that spreads can be volatile. They tighten in, they widen out on various degrees of information or various types of information entering the market, anxieties that occur from that information. So whether it was concern about China imploding or the decline in oil or energy prices generally suggesting some degree of weakness in the global economy that may not have been the case, you become subject to this sort of volatility. It's a normal occurrence in the bond market. One of the things we don't do is overreact or chase the market or trade actively in the short term to try to avoid it. Having said that, opportunities do occur. Back in during the midst of that spread widening, there was concern about global banks. As it turns out, banks here in the U.S. are in particularly solid shape. To be clear, we're not advocating the equities of U.S. banks. We think there's difficulty improving bank earnings, but banks have been turned more into utility-like entities from all the regulation the banks are facing. We think they're particularly solid credits here in the U.S. So one of the key things we did during that time was we increased allocation to large U.S. banks. But most importantly, we try whenever possible to keep trading activity to as low a level as is reasonably possible to keep costs down within the fund. We think that over time that makes a difference in total return.
So when would you expect, Lou, to significantly adjust the exposure of the portfolio and potentially get more conservative?
Sure. The simplest answer to that in a single word is recession.
Yep.
And of course, the trick is not to do it once the recession is upon us, but to do it in anticipation of one. So when you think about our skill set, again, being credit selection and asset allocation, the two of those best intersect in terms of having a good handle on what's happening to the economic cycle, and as a result, what might be happening to corporate credit worthiness. So the key is we've been able to do successfully in the past. And I speak with some advantage. We've been together as long as we have, meaning 3 or 4 cycles at this point. So this idea that we've managed to put together a good track record across our bond strategies over multiple economic cycles suggests, while certainly not guaranteeing, that we're able to manage through those periods reasonably well. So the hope is, and the design of the portfolio certainly is, to start to deallocate away from corporate credit risk as we get closer to the end of this phase of the cycle, which suggests, or should suggest, as we move forward here, as things stay at a reasonable keel, a good return profile for corporates, but at some point that coming to an end.
Very good. Well, Lou, thank you very much for your time today. We look forward to seeing you again in Australia shortly, now that we've launched the MacKay Shields Unconstrained Bond.
My pleasure, Ross.